Welcome back. This is Si Wing Yi from the Yi Real Estate Network, and today I'm going to cover topics on home equity positions and the changes as respect to what's going on in relationship to the real estate housing market. And by the end of this video, if you see the value of this presentation, please smash the like button and also subscribe to my YouTube channel. And finally, you may also provide your email information into our newsletter so you can become you can receive free real estate education through your email inbox on a weekly basis. So you could learn how to become a very successful mom and pop real estate investor. All right, so without further ado, let me go ahead and I'm going to go over the CoreLogic information. Just an article just came out today, 9 December. But before I do that, I'd like to reiterate, I like to not only that, I like to motivate and inspire all those people out there in the YouTube world and any other social media that you are, for those that are watching my videos on a weekly basis or whatever educational platform that is. There's a lot of different ways you can become wealthy through home ownership as a primary homeowner or as a real estate investor. Right before I go any further, I'd like to take a step back and share with you. This is a very important metrics. This is economic 101. It's a supply and demand curve. U.S. home equity surged to over 27 trillion as the value of the housing stock passes 39 million. And with that in mind, this slideshow indicates that a lot of sellers are quote locked in unquote situation because 9 out of 10 mortgages have an interest rate of 5%, and more than 40% of all homeowners don't even have a mortgage. They're totally debt free. Isn't that cool? So as you can see right here, the ratio of home equity versus the mortgage debt outstanding, we're talking like around the 50th percentile. It's called loan to value. So that's pretty substantial equity. Most people, just the average nationwide, people have at least $40,000 of equity in their home. So what I'm trying to say, is that on the average, 2/3 of the net worth of Americans comes from home equity. Okay, so that's the history. So you must understand history long term if you want to create wealth. Most people have their wealth tied up to their home, either primary home or rental property homes. So with that in mind, I want to share with you where do you stand in relationship to everybody else. There are like 350 million Americans living in the US and all over the world for that matter. If you want to be the top 1% of Americans in terms of wealth, in terms of net worth, the estimated, according to US Census Bureau, you need about a little bit more than $10 million of net worth. What I mean by net worth, net worth is assets minus liability equals net worth. Okay? It's pretty simple. It's finance 101, economics 101, etc., etc. Now, that's a pretty overwhelming task. Okay, if you're the average Joe or average Jill out there, that's quite overwhelming. Perhaps unattainable for most of us. But then again, now here's the next layer. If you want to be the top 2% of Americans, all you need is around $2.5 million net worth. Right? So yeah, I live in San Francisco Bay Area, California, and look at our own real estate primary home, mainly in California, and rental properties out of state. That is, I mean, very easily, if you buy a home in California, in my case, 30 years ago, if you hold it for long term, it's pretty easy, right? It's pretty easy to amass to around $2.5 million of net equity. All right. So again, if you live in other part of the world, I mean, of the country where the housing prices are not that high, then it's kind of hard to become the top 2%. But then now the next layer is if you want to be in the top 5% of the Americans, all you need is a million. So therefore, you don't need to live in California. You don't need to buy a California house and invest for the long term, stay at your house for the long term, 10, 15, 20 years in order to amass 1 million. Could be, you could potentially live anywhere in the US, any of the 50 states. But over time, as long as you invest appropriately, buy more than one house, for example, buy one or more rental property, over time, depending on each situation, you could very well achieve $1 million fairly quickly. Okay, not that long, anywhere up to 10 years on the average. Top 5%, not that hard. If you want to be in the top 10%, all you need is around $800,000 net equity. So buy a couple of rental properties, hold it for 10, 15, 20 years. You might reach that level. It's not that difficult. And then the top 50% of Americans, all you need is like $500,000 of net equity. So, it's not that hard, like I said. So anyway, that's pretty much it. So with that information, now I'm going to segue and go over the main topic I wish to discuss right now. Oh, by the way, going back to the information I just shared with you, because the homeowners today they are controlling the real estate market. They are controlling the housing market. Clearly, it's not going to be a housing crash. The reason why is in order to have a housing crash, you need stressed sellers because most people own so much equity in a home and they're locked in such a low interest rate. They're not going to sell their houses. They're going to they're going to hoard their amazing historic low mortgage rates, 30-year fixed rate mortgage at 4%, at 3%, at 2.5%. There's no way they could get rid of it. There's no way they can sell their house and move into upgrade to another house, paying 6 to 7% in a mortgage rate on a new house, which potentially costs more than their current house. So sellers are not selling, they have very little motivation. So for those of you who are thinking you're waiting for a real estate crash before you do something, well, I'm here to tell you, you could be waiting for a very, very long time. Some of you want to debate me on that, but I'm willing to debate you anytime, any day, and twice on Sundays. I got this from a movie, A Few Good Men by Tom Cruise. All right, let's go to CoreLogic. Okay, I don't want to waste too much time. CoreLogic and came out with December 9th, which is today. CoreLogic is a very reputable data collection firm. They, for the past many, many decades, so they're very credible, CoreLogic. So this article came out today, Homeowner Equity Insights. They only go up to third quarter 2022, which is September 2022. In order for you to get the fourth quarter 2022 information, you have to wait until probably next February 2023 before I'll come up with this new video to show the Home Equity Insights quarter four 2022. So the cutoff point for this organization, CoreLogic, is Home Equity Insights up to quarter three 2022, which is September 2022. All right, introduction. The CoreLogic Homeowner Equity Insights Report is published quarterly. That's why quarterly right now is December, January, February, or March. You can hear me talk about another video to go over the updated information on Homeowner Equity Insights. Okay, so they talk about it's published quarterly with coverage at the national, state, and core-based statistical area, CBSA, metro level, and includes negative equity share and average equity gains. So the definition of negative equity is often to as being quote, underwater or, quote, upside down, end quote. Applies to borrowers who owe more on their mortgages than their home are worth. Negative equity, I was going to say energy. Negative equity can occur because of a decline in home value or an increase in mortgage debt or both. So this data includes properties with a mortgage. Non-mortgage properties that are owned outright are not included in this study, which is people who are free and clear of mortgage debt. By the way, which is, you may be surprised. Do you know 40% of American homeowners does not have a mortgage? They pay it off. It's free and clear. Just goes to show you the power of owning real estate, either a primary home or a rental property. So my inspiration and my motivation to all of you YouTube consumers out there, I'm not telling you to buy right now. Everybody have a different situation and goals and objectives. But if you buy property and as a primary purchase or as an investment purchase, all you have to do is show discipline and invest for the long term. Okay, don't do any kind of flipping. Don't buy a house and try to sell it the next month or 6 months later, whatever. It does not work because you can't time the market. You have to buy and hold long term. Okay, let's go on. Home equity, Q3 2022. So CoreLogic analyzed shows U.S. homeowners with mortgages, which is roughly 63% of all the properties, have seen the equity increase by a total of 2.2 trillion since the third quarter of 2021. A mere 1 year, they have gained 15.8% in equity, which is right here, as you can see, all the way to 2.2 trillion. Wow. How many numbers is a trillion? Okay, I don't know. It's a lot of numbers. 2.2 trillion is massive amount of wealth. So again, for those homeowners out there who will have the wherewithal to buy a home and live there or invest it for the long term, you are reaping the benefit of your fruits of your labor. Therefore, congratulations. So let's go on. This article is all about any kind of a short-term impact on the equity position, given the real estate housing correction that we're going through in the past 9 months. So let's focus back on this. So in the third quarter, the latest quarter, per this study by CoreLogic of 2022, the total number of mortgage residential properties with negative equity have increased by 4% from second quarter of 2020, from 2022 to 1.1 million. So 1.1 million homes, or almost 2% of all the mortgages, have some equity, negative equity situation. So on a year-to-year basis, negative equity fell by 9.8% from 1.2 million, or 2.2 of all mortgage properties in the third quarter of 2021. So some of you are thinking, oh, what about foreclosure properties? No, that's down the road. But foreclosure situation on a historical basis is very, very minimal. Is a lot less even than the pre-pandemic years. So only like 2% of all mortgages have negative equity. So very minute percentage. There will not be a foreclosure crisis based on the current situation, and there's very little stress because the home prices have risen so much, especially in the past 2 years during the pandemic real estate boom. Does that make sense? So the CoreLogic home price index forecast projects home prices will increase by 3.9% from September 22 to September 2023. All right. So national negative equity, Q3 2022, year-over-year change has decreased by 9.8%. in which 120,000 homes have experienced such decrease. So anyway, U.S. home equity gains home equity gains slow sharply from Q2 to Q3 of this year. So right now, the average home equity nationwide average per owner is around 34,300, compared to nearly $60,000 year-over-year gain recorded in the second quarter, and an additional 43,000 properties falling underwater. So it's a slight problem, nothing major. So this graph shows the negative equity share. This orange color indicates very high negative equity reduction on a short-term basis, and then the darker red shows a high level of negative equity share. This dark gray is moderate, and this light gray is very low. So what does that mean? That means, so let's go over these states briefly. So up and down the Atlantic coast, we have a light gray. So the percentage of negative equity is very, very minimal. So this means the homeowners along the Atlantic coast have done well. Their equity have decreased very, very little, if any. Okay, and moderate negative equity share, a little bit darker gray. I'm so sorry, I was wrong. The low portion are here in California and Nevada and Arizona. I mean, they, okay, negative equity share. So as hold on. Oh, so hard to see. As low relative to the total equity those people have in their home because of the high value houses in California and Arizona and Nevada, right? So and then the dark red, which is high equity, negative equity share is high along these states. A lot of them are in the Midwest, Alabama, Tennessee, Kentucky, Ohio, Pennsylvania, and New York State, and Michigan, and in upper north. They have high negative equity share situation because home prices, average prices are low in those areas, and any any small percentage decrease in equity impact the overall price of their properties. However, like I said, housing prices that skyrocketed in equity the past few years, especially, they are still able to have a lot of equity left because these kind of boom town have done very well in the past 2 years, which is along the Florida, Georgia, South Carolina, North Carolina, Virginia, and Texas. Texas have done well in terms of skyrocketing appreciation, and of course, here I believe it's New Mexico. So over here is Utah. Anyway, so again, California, Nevada, and Arizona, because of the huge median price of homes and skyrocketing of home prices, the negative equity didn't affect them as much. All right, so let's go on. The article going to say that at 43.6%, almost half, almost 50%, the average U.S. loan-to-value ratio, LTV, loan-to-value ratio, is only slightly higher than that of the past 2 quarters, and is still significantly lower than the 71% loan-to-value seen moving into the Great Recession in the first quarter of 2010. Right, the housing crash of 2008. A lot of people have very little equity. They're upside down. As a matter of fact, that's the reason why the housing crash occurred back in 2008, and it lingered for several more years. But we're not seeing any of that right now. Right now today is very, very different than 2008 housing crash. I'm sure you guys know it by now. You hear it from not only myself, by other educational platform as well. I have to assume that. So therefore, today's homeowners are in a much better position to weather the current housing slowdown potential recession than they were during the housing crash in 2008, 2009, 12 years ago. Okay. Now, nevertheless, while these negative impacts are concentrated in western states such as California, homeowners with a mortgage there still average more than $580,000 in home equity because homes in California are super expensive. I live in the Bay Area for the past 30 something years, San Francisco Bay Area. I mean, the average median price of a home in my area is like $2 million. So even with a 10% drop in equity, I mean, is a drop in a bucket, if you will. So I'm not speaking for all Californians, but California over many decades they experienced a real estate cycle such as the one we're experiencing right now. But we're not stressing out as long as we have a stable job, because our homes that we purchased are such a high value years ago, presumably, and a slight reduction of homes that we are experiencing right now, we're not, it's not a major concern. Okay, so that's why the purpose of this sentence right here. So national homeowner equity, average equity gain, right? So the average equity gain over here, this color is red, light red. That means more people have, the housing prices have increased. As a result, the equity have increased. The most, this orange, are located in Hawaii, which I have a vacation home there, good for me. And of course, Florida. Of course, many of our investors are buying cash flow rental properties through my guidance over the past 20 years, really. So not surprised, Florida is among the top in terms of equity growth because it's the most desirable place to live. What else can I say? So the second category is dark red, average equity growth between 30 to 40 to 60,000. Again, they're located in the Sun Belt. Sun Belt, as we all know, warm weather areas, which is the fastest growing area, although there are some boom and bust boom towns that we say, we all been hearing it lately, Austin, Texas, and Boise, Idaho, and Las Vegas and Phoenix, Arizona, and California have gone through some, pretty severe correction. I would not say crash. Right now, it's estimated between 5 to 10% price reductions in this boom and bust market, at least temporarily. But then again, you have to look at what happened during the pandemic. These areas, these boom towns have achieved 40, 50, 60% appreciation, right? So if you achieve 30, 40, 50% appreciation in the past 2.5 years, and then the past 9 months, you have a 10% reduction in home prices, your net gain is still pretty substantial. That's why this dark red indicates, you still have a fair amount of equity, average equity gain. So you're second in line. And then the moderate appreciation gain are dark gray, which is, a lot of it in the Midwest, right? Okay, I'm not gonna go into too much, but, and some of it in the North and Northeast, mostly in the Midwest, but the median price for those homes in the Midwest is very, very low. So therefore, the equity position is low. So that's pretty obvious. And then the light gray is the least amount of equity gain in the past 3 years. And they are, also in Midwest somewhere. Sometimes I can't tell between light gray and dark gray, but they're mostly in the Midwest and various parts. Okay, so now you know what's going on with the big picture. So negative equity have seen a recent decrease, of course. We're going through a correction. Las Vegas have the least is the least challenge with the negative equity growth at 0.07%, and nothing to sneeze about. I mean, followed by LA, San Francisco, California. The West Coast regions are experiencing the biggest price drop. All these are indication. Here are some of the areas. The larger metros: Boston, New York, Washington, Chicago, Denver, Las Vegas, San Francisco, LA, Houston, and Miami. Yeah, they're going through some, larger price drops than other markets in the country. But then again, like I said, they have achieved the monumental historic rise in appreciation during the pandemic. So, I wouldn't worry if I were those people living there. They still did very, very well. They just gonna have to stay in for the long term. You just ride out the storm, ride out the storm. That's all. Loan to value ratio still quite substantial for most people. 50% loan to value. Only a small percentage of homeowners have negative equity, so we are not seeing too much of a stress market, at least not just yet. Who knows what's going to go happen in 2023 with the pending recession and job market situation and the high interest rate. All those factors and recessions and inflation, remains to be play out as we move toward 2023. So, in summary, CoreLogic began reporting homeowners equity for more than 12 years, since 2010. So at that time, back then, of course, the equity picture was rather bleak because U.S. is just coming out of the recession, housing crash back in 2008, 2010. But since then, many homes have regained the equity, and the outstanding balance of the majority of mortgages in this country are now equal or in a positive position when compared to their loan balance. So okay, as I summarize everything, as I conclude this, so what am I reporting? What's the topic? I mean, what's my objective? My objective is, yes, we have seen some negative equity, I keep saying energy, negative equity drops, but hopefully this is just temporary, right? I mean, if you don't sell your property, you're not going to be subject to lowering your prices and what have you. But if you if you have the discipline to hold the property, you don't have to move. You don't have to. I know some people, they must sell the property. They must do this. Their life situation, whatever it is, they're forced to sell. They will be subject to the market volatility as we are experiencing right now. But if you are a long-term buy and hold primary homeowners, if you want a long-term buy and hold real estate investor, there's nothing wrong to buy at this time, because over time, in a 10-year investment horizon, housing prices always rises. Right now, you have to overcome the storm, and just ride out the storm, and you'll be fine, but okay. So anyway, as I conclude this, if you receive value from this presentation, please smash the like button and subscribe to my YouTube channel. And finally, submit your email, sign up for our newsletter, so you'll be part of our community of real estate investors. You can receive free weekly real estate investment information that will help you achieve your definition of financial freedom. With that in mind, thank you for listening. This is Si-Wing Yi, and I will see you on my next video very shortly. Thank you so much. Have a nice day. Bye-bye.